let's welcome on board then Mukul Kochhar as well, Head Equities Investor Capital Services, joining in on the show right now. Mukul, hi, good morning. Good to have you on the show. Mukul, what is it that you're making of the markets right now? While all the high-speed indicators seem to be, in favor of us, but do you think the market is priced in pretty much all the good for now?
Yeah, so there are some concerns, concerns largely external, and I'll first just talk about that. What has happened is because the Indian market relatively on a relative basis has done very well, foreign investors have taken an opportunity to book gains. Yeah, that was the story last year, and we expect that story to continue for this year and maybe into the near future. um, uh, you know, what has that resulted in is that capital flows, which used to provide a cushion to the currency of roughly $40 billion per year, that turned neutral in FY25. Yeah. Now, to balance that, if capital flows are neutral, you have to have a neutral trade balance. Yeah, that's just basic economics. And to have a neutral trade balance, we need to sort of have be part of the global supply chains and have some sort of an understanding on trade with the large trade blocks, US, Europe, etc. There's which is talks on which are underway, and that is why so much focus of the market on what's going to happen on the US trade deal. So very critical to get that right, and I think that could be a near-term catalyst to look at for the market. If you look beyond, the external, which is the capital flows and the counterbalancing trade equations, the market's actually pretty okay. Yeah. We are expecting double-digit earnings growth for BSE 500 in FY26 and FY27. Remember that inflation structurally in India is down. Yeah, inflation is down from higher than 5% or close to 6% in the last average of the last 5 to 10 years to now 3%. Despite this lower inflation, our earnings growth has kept up, and earnings growth is double digit. In which case, valuations are well supported. You have reasonable earnings growth. Valuations are well supported given lower inflation and lower interest rates. So structurally, we are actually looking pretty good. I can talk about a few more points about this, which is responsible fiscal management by the government, which is what is leading to lower interest rate. A high corporate profitability, which is positive for upcoming capex. So there's multiple sort of positives brewing for the market. The only concern being whether we are able to sign some sort of a reasonable trade treaty to be part of global supply chains.
Right, that's a take coming in on the markets. Hi, morning, Mr. Kochhar. This is Shrishti also joining in. But since you expect a
Yes.
double-digit earnings growth from BSE 500 companies going ahead, help us understand which sectors are you betting on, and right now, which sectors are giving you a valuation comfort as well?
So domestic cyclicals, we've been on that theme for the last 3 4 years. I think that continues. The economy is more savings and investment led economy. So that those are the themes. Those themes are largely domestic. So in that environment, financials I think will do well. So we are selectively positive on the banks. Both we have some picks in the large cap space. We have some picks in the mid cap space. We even like some PSU banks in this environment. Some NBFCs also are attractive, including lending and non-lending. On the non-lending side, some capital market exposed, which are savings related NBFCs, they are very attractive. We have reasonable sort of comfort in industrial names. The leading industrial companies look attractive right now. We believe that the auto sector also, there's some reasonable picks. So on the domestic cyclical side, we are not having trouble finding reasonably priced stocks with decent growth, momentum in them. Where we have a little bit of a concern is around, of course, when I said the economy is going to be savings investment led, domestic consumption is going to suffer there. So consumer staples, we are negative. We are also negative on Indian IT services, largely because valuations are not supportive. If the currency dynamics are not favorable, we think the large cap IT is not going to deliver good returns from here.
So that's the take on sectors. Mr. Kochhar, hi, this is Snehi also joining in morning. Give us your sense
Yeah.
on the kind of foreign flows that we're seeing into Indian equity markets, because in the middle, some time ago, we had seen a little bit of a pickup in FII flows, and that's once again dropped, and now we're seeing a series of selling once again. Where do you think the FII flows are headed, and what kind of cushion do you think this provided to the market, and now that's gone away?
Yeah, so there are two kind of capital flows on the equity side that come into the country. One is the foreign direct investment, which is long-term capital expenditure related flows. Those are actually fairly stable. That we get 75 to 80 billion dollars, a year, and that continues. Yeah, that has trended over the last 6 7 years, and that's continued. Um, the short-term flows, which is the FII flows, which is what you spoke about, that actually varies depending upon how attractive opportunities are in the market, which literally, I mean, could turn every few months. In March, the market had become very, very attractive in terms of valuation, and foreign flows were good for the next 2 3 months. Now the market is up from those levels. I mean, it's like 10 to 15% appreciation, and therefore people are taking some profits. That's very normal. There's nothing to worry about. On the flow side, what has really sort of changed in India in the last 1 2 years, which is where I said on the capital flows we need to think about something, is outgoing FDI investments. Yeah. So outgoing FDI investment includes people having come in, made capex 6 7 years ago, and now selling down and booking profits on those, including Indian companies who are flush with capital today investing outside. That actually has really picked up on a structural basis, and that's where we need to think about it a little bit. But FII equity flows, they come and go, nothing to worry about there.
Is this the time to put fresh money to work, or at least wait till, to see what happens on July 9th with tariffs?
Yeah. So July 9th is going to be, I don't know whether the market really reacts a lot that day, but I think it's fundamentally for India a very, very critical date. Yeah. But I don't know whether market reacts really on that day itself, because it's not like on that day something is going to break. It's just that it just tells you that, the rupee and the external is going to have a tough time if we don't sign a reasonable deal. But I would incrementally be sort of concerned, yeah, if we don't get a good deal by July 9th, or even an indication that in the next few months we're getting there. So that's a concern. Outside of that, I think if we have a reasonable probability of getting something with the US done, because it's in the interest of both countries to sort of encourage trade between the two nations, both geopolitically and economically. It makes sense. So we are assuming that something gets done. Based on that assumption, the market looks pretty okay. Yeah. Once you take that assumption into account, market looks pretty okay. Double digit growth in FY26. Market multiples, which are on average with the last 10 years, despite the fact that the risk free rate or, the interest rates in the economy are lower. Remember, as interest rates fall, multiples should be higher. Despite lower interest rates, multiples are at the same level they've been in the last 10 years, and we are expecting double-digit growth. So market momentum, market expectation is fairly okay. It's just that, as you mentioned, we want to get by this July 9th deadline without getting hurt. Yeah.
Could be well before July 9th, as was the case with Vietnam. So, yeah, fingers
Yes.
crossed on that. But, Mukul, what about earnings? Can they really sort of comfort us in terms of how the internal macros are shaping up and the health of India Inc.?
Yeah, so a very good question, right? Because when I said the market's looking okay, the first thing I said is that the earnings growth expectation is double digit. So you got the right point that if earnings growth don't deliver, then returns won't come. What gives us comfort around owning earnings is the latest data point, which is 4Q earnings. When we annualize the 4Q earnings, which is just multiply them by 4, we already account for 98% of the earning expectation for FY26, which means that if there's no sequential growth from here, from 4Q, we will still get to 98% of FY27 earnings. That's a good space to be in. So 4Q earnings give us good visibility into growth in FY26. And that is where we are saying you'll get double digit 10% plus growth because fourth quarter of FY25 itself was very strong. So that's essentially the confidence of earnings and our expectation that the market should do pretty okay.
All right, but Mukul, since you were just highlighting one of those facts that the government capex is actually making a comeback, but off late, Mukul, the fact of the matter is that nobody is talking about the PSUs rather, and especially post the run up that we have seen COVID, most of these stocks are now seen to be taking a breather, barring that defense and the railway pack. Give us your sense that how do you see PSUs as a basket, and why is there a reduced optimism or enthusiasm around them right now?
Yeah, so broadly you're right. They've taken a breather, and that's very normal for markets. They run up and then people reevaluate. There's some profit taking and stocks consolidate. Let's talk about PSU banks, yeah, which I mentioned just right now. On a fundamental basis, these stocks are trading at 5 to 6 times earnings. Despite delivering very healthy return on equity of 15-16%, growing at 10%. So any person punching those numbers for a fundamental valuation will say these stocks are very, very cheap. Yeah. Where the concern is that people have book profit, the market is taking a breather. And secondly, people are expecting that near-term earnings in these stocks may be challenged. I think that on a fundamental basis, these stocks are very attractive. The PSU pack in general over the last 7-8 years has seen an improvement in governance structures substantially. Yeah. So, which means that the historical benchmarks of valuation should be reevaluated by the market. That reevaluation will happen slowly. I think that some of these stocks, and you correctly pointed out, maybe in defense stocks are very expensive, but in the other sectors, like financials, we should definitely take a relook just based on pure fundamental valuation.
Mr. Kochhar, once again coming back to your sectoral view, you did say you were negative on consumer staples. But what about other subsectors in the entire consumption basket? Maybe autos, maybe retail, QSR, anything from that end looking good?
Yeah. So each and all three of these sort of sectors that you mentioned in the consumer basket have their own dynamics. Yeah. So first of all, just broad consumer staples in India is a very well discovered sector. Remember, 62% of our economy is consumption, and we are not a small economy anymore. We are a $4 trillion economy, 62% of which is consumption. So the staple consumption company in India fully scaled. Yeah, they're large companies by any measure globally. So on that base, expecting very high growth is unreasonable, and that growth expectation has to come down. And as that growth expectation comes down, the multiples that we pay of 40-50 times will be re-examined by the market. So it's a combination of just company scaling, market moving away from consumption to savings, and consumer staples being scaled companies and high multiples, which may make them unattractive. The sections of the market that you correctly pointed, they're discretionary consumption. Now, the base of that, unlike consumer staples, the base of discretionary consumption is very, very low. We expect discretionary consumption basket itself, the demographic that can, afford discretionary consumption, like going to a hotel, like going to a restaurant, like owning a vehicle. That base demographic itself, or the number of people who can afford such luxuries or discretionary consumption, I would say in India, is growing at 10% plus. So that discretionary consumption of the part of the market is very attractive. Yeah. So in that, we have to look at dynamics of each sector. So for example, retail still very positive because there's nothing really taking away from retail. As people are consuming more, those companies are benefiting, high growth companies. Autos have their own dynamics, but I get attracted to the fact that these companies are exceptionally well run, especially two-wheeler companies, and multiples are reasonable. QSR is having its own issue because, discretionary consumption in eating out is increasing, but that all that growth is being taken away by Swiggy and Zomato. So QSR itself is seeing, lower growth because growth is happening elsewhere, even as the category is expanding. So all these three categories are expanding, but stocks have their own dynamics.
On that note, Mukul, while we await not just the earnings, but more importantly, what comes out of the India-US tariffs, good to have you on the show. Good to get in those
Thank you very much
insights.
for having me.